I'm Brian Arcese, Portfolio Manager on the Foord Global Equity Fund and Foord International Fund. I'm joined by JC Xue, Portfolio Manager on the Foord Global Equity Fund and Asia ex-Japan Fund. We're here today to chat about China. JC, thank you for joining me.
Thanks for having me.
So if you kind of take a step back and you're an outside investor and you look at everything that you just chatted about, the regulatory headwinds, the COVID-0 policy, the National Party Congress not necessarily turning out as investors had hoped, you can see not necessarily that investors would feel that China was uninvestable, but that it would certainly have a higher bar to jump over. So maybe you can walk us through how you arrived at enough conviction to recommend not only holding many of our positions, but adding to them in 2022.
Sure. So our conviction is really driven by a couple of things, right? It's about the quality of the businesses that we own and the valuation that we own them at, right? So firstly, on the quality of businesses, the Chinese businesses that we own, even though the last 2 years have been extremely challenging, they were all generating very strong free cash flow that allowed them to even buy back shares at various points of time across the year. And then in terms of the valuation of the businesses, they were trading at levels which implied that some of them are no longer going to grow anymore in the long run, right? So once we try to reconcile that valuation level against some of the theses that we had behind, circular growth trends, right? Growth trends that we're investing behind, things like overall Chinese travel demand, things like growing e-commerce penetration, or just simply, growing digitalization across China, which would drive increased demand for things like cloud computing or digital advertising. All these circular trends were things we believe in 3 to 5 years was going to continue to drive growth at the businesses that we own. So once we see the valuation, it's priced almost as if the growth doesn't exist anymore, that really gives us the comfort and conviction to bet behind the businesses that we own. And perhaps to give a more specific, sector-specific example. So the thinking that we had behind the gaming sector, which is a big piece of China internet businesses, right? The market was extremely worried last year, worried about the fact that maybe China government is no longer, aligned with the gaming sector because, gaming sector is bad for kids and so on and so forth. Our thinking was if China had ambition to become a global superpower, then they need a medium to help them project soft influence. They need to export their culture globally, much like what Hollywood did for the US, right, over decades and decades, right? So China is already a leader in the gaming business, right? They can use gaming as a medium to tell uniquely Chinese stories and export, soft power and culture overall. And if we look at, the gaming space as a technology, the technology aspects of, graphics, as well as AI within the gaming space is advancing rapidly. So from that angle, it actually holds strategic importance for China as well, right? So looking at this from a strategic angle helps us gain comfort that, the Chinese government sees the importance of this sector over time. And as such, the temporary pausing of game approval is just that, it's temporary. So when we determine it to be temporary, it means that, when we see a haircut in the valuations of businesses like Tencent or NetEase, right, that is the opportunity for us to add more to our positions over the last 2 years.
And I think even if you take as a given that from a strategic standpoint, many of these investments remained sensible and compelling, and as you outlined, doing kind of the bottoms-up fundamental work, the valuations were simply too cheap to be sensible. But how then do you take into account sort of the politics within China, the changes in the regulatory environment, or the outcome of the National Party Congress? How do you handicap that, or what work have you done to get comfort that that piece is not going to make Chinese investments kind of not as compelling going forward?
So I think the piece about new leadership appointments post the Chinese Party Congress is something that a lot of investors were very worried about. So we looked into, the backgrounds of some of the newly appointed officials, and one of the worries was, what does it mean for, economic growth as a priority within China going forward, right? So we look at the background of the next premier, Li Qiang, for example, right? And we realized that his reputation on the ground is actually, he's known to be a very pro-business leader, which is in contrast to what some in the media was portraying him to be, right? So he was the one who actually brought Tesla to set up manufacturing facilities in Shanghai. He was the one who championed the setting up of Starboard Shanghai, which is the NASDAQ equivalent in China, to help many of the tech startups and technology companies list, right? And then if we look at another candidate, He Lifeng, who's slated to be the new economic czar taking over from Liu He, you know, again, he has a history of being very pro-growth. He was the head of Fujian province. He was the previous head of the NDRC, you know, and he is actually coming into the role with a lot more experience than Liu He did when Liu He first started, you know, that many years ago, right? So while these people might be Xi's men, it doesn't mean that they are coming into these roles without credential. It doesn't mean that economic growth is going to take a backseat. It doesn't mean that, you know, policy for sure is going to end up, you know, being driven in the wrong direction and so on and so forth. So that's, you know, something else that gives us comfort, that anchors many of the positions and exposure we have to China overall.
And obviously, if we look at the performance over a relatively short period of time, but certainly a very large rebound in fourth quarter, where Chinese markets in general rose about 40%. So certainly far and away ahead of global markets. But as we move into 2023, maybe you can just talk a little bit about what your expectations are. I mean, after that big move, where do valuations sit today? And how do you expect that Chinese market to shape up relative to kind of its global counterparts as we move through the year?
Sure. So for 2023, we are cautiously optimistic. I think there are many signs that point to 2023 being the first year of a growth cycle rebound in China. So for example, China is finally opening up to the rest of the world, right? That took some time, but, you know, finally we think the pent-up demand within China is going to come back this year. And then we also looked at the recently concluded Economic Work Conference in China, where the leaders of China set the policy goals for the new year. And there were three key things that came out of that conference, right? Number one is now they're actually talking about finding ways to support platform internet businesses, which is a huge contrast to the rhetorics over the last 2 years. The last 2 years was just regulation, clampdown, and so on and so forth, right? And then the second piece is restoring the overall consumer demand in all of China, and they have already kickstarted that by removing many of the COVID-0 policy that disrupted not just the consumer sector, but also overall industrial sector. And then last but not least, just in terms of the property sector, they are looking at ways to ease some of the liquidity restrictions they place on different property companies and the banking sector, which we think will go a long way to ease, you know, some of the stress that the sector has been under over the last 2 years. So across 2023, we think we're going to see more and more policies come up to support each of these three priorities, all of which would, you know, support a rebound of growth that is likely to come true across the rest of the year. And then just lastly, to touch on the valuation bit, yes, you're right, the market has rebounded quite substantially from the bottom they experienced in October. But, you know, the valuation level, so if we take Hang Seng Index as a proxy, right? Hang Seng Index has rebounded, but still trades below its long-term average PE ratios. And then in terms of the businesses, the Chinese businesses that we actually own, we think the valuation still stacks up pretty well, and the valuation is looking pretty attractive on trough earnings. So again, as some of the growth, the earnings growth start kicking back for the businesses that we own, we think the setup is looking pretty nice for the businesses we own as well.
Thank you, JC. Very interesting and really helpful. And thank you all for joining as well. As we always say at Foord, it really is about long-term earnings and long-term fundamentals. We believe firmly that earnings, in particular cash earnings, drive the value of a business. And as JC articulated, it's that fundamental research that allows us to build conviction in the holdings that we hold in our portfolio. Thank you.